Hello, and also hello. Now, I understand I'm like 2 days late to Friday's daily recap show. So, to all of you, my subscribers, bulls, bears, new viewers, crypto bros, and everything in between, I would like to take this time to apologize to absolutely nobody. The greatest finance YouTuber of 2024 does whatever he wants. Let's roll the tape. Welcome everybody to the Daily Recap Show where we talk about stocks and the financial markets. My name is Chase. If you like this video, please subscribe, hit that notification bell as well as the like button and leave a comment for the algorithm. Let's get into it. This is the daily heat map of the S&P 500 and US stocks notched another record, extended their impressive winning streak in 2024 on Friday after powerful earnings propelled the big tech sector. Those earnings coming from Netflix, it was up 11% on the day, and in turn that saw stuff like Amazon, Apple, Google, Nvidia all post green days. However, it was broad-based gains across the board today. We saw gains in nearly every sector, especially cyclical and rate-sensitive sectors. Real estate, industrials, utilities, basic materials, cyclicals all did very, very well today. And the gains came off Netflix's earnings, which climbed more than 10% on Friday after the streaming giant beat third quarter EPS and revenue estimates, as well as raised guidance for their next quarter. The majority of their earnings growth came from their advertising business, which is very new to Netflix in the last couple of years, and that really did set a fire under tech stocks. Apple was up 1.24% today, following an industry report showing a surge in China iPhone sales, some reports saying as much as a 20% surge, and that's really going to bode well for the end of 2024 as well as 2025. We're going to see how that's going to materially affect Apple's earnings. We also saw American Express fall 3% today. However, from the lows, American Express was up 3% on what was very good earnings. They reported better than expected third quarter profit and lifted its full year guidance on strong consumer spending, but investors still pulled back because revenue came in slightly lower than analysts forecast, and that just goes to show the valuation of this name right now. Nonetheless, those that did buy the dip, especially in the AM on Friday, were very, very happy with the gains they saw into the end of the day. But looking at the sector analysis on the day overall, the best performing sector was XLC, up 0.74%. The worst performing sector was XLE, the energy space, and that's because crude fell significantly. However, every sector did gain here on Friday. The S&P 500 was up 0.38%, or the SPY ETF. Sectors that underperformed the SPY was technology, industrial, staples, and financials. Those that outperformed the SPY was the discretionary space, materials, healthcare, utilities, real estate, and comm services. All in all, a very bullish day. And looking at the sector breakdown for the week, the last 5 days, we only see two negative sectors for the week, energy and healthcare. Other than that, it was broad-based gains, very bullish price action. The S&P 500 gained 0.86%, just shy of 1%. Staples, industrials, and technology, all positive, underperformed the SPY, and the best performing sector here today was utilities as well as real estate and financials. So very cyclical and rate sensitive sectors outperforming on the week. And again, this goes to the broadening out we're seeing in the market. Now, looking at earnings for the week, guys, so far earnings has been absolutely blockbuster. Look at all of this right here. This is how much earnings has surprised to the upside. United Health had an earnings surprise. Same with PG, Johnson & Johnson, Netflix, Bank of America, Blackstone, Abbott Laboratories. It was a very, very good week of earnings, particularly in the insurance and financial space. Progressive, Goldman Sachs, Intuitive Surgical, Morgan Stanley, huge earnings beats, and that's why we saw XLF outperform here on the week. Not the best performing sector, but a 2.4% week. You take those weeks any day they come. But going back to the price action on Friday, we saw large caps outperform the rest of the market. The factors you didn't want to be in today was value and core in the small cap size. However, it was negative 0.05 and negative 0.07. Inconsequential. You would just call those gains relatively flat. Really, the place you wanted to be today was sort of just growth in the large cap and mid-cap space, but really it was just outperformance from large caps after Netflix earnings and that report we got from Apple. And in light of all of this, the data we got today was very average. Housing starts and building permits pretty much came in line with analysts' forecasts. 1.35 million was the forecast and the report on housing starts. Building permits came in slightly weaker, and that's part of the reason why we actually saw a little bit of underperformance in small caps. A huge part of the Russell 2000 is REITs, and these figures, which is literally how many houses are being built and how many houses are set to be built, that's why the Russell 2000 and small caps as a whole really did underperform. But looking at the bigger picture, market breadth, things look very, very constructive. Yes, we did pull back from the highs we made in the last week. However, market breadth still looking very, very constructive in the shorter term trends, looking at the 5-day, 20-day moving average, as well as the medium term and longer term trends. So when the market is exhibiting this type of strength, you want to hold equities because you get rewarded for it as a shareholder. But let's dive into the charts. And looking at the charts, guys, we saw very bullish momentum in equities in everything except small caps. The IWM and the S&P 600 were the only two decliners in today's market. We saw gains in the S&P 500, the Nasdaq, the RSP, and mid caps were virtually flat on the day. Gold and silver, not so much crude, but silver was up 6.4%, gold up 1%, and that mostly had to do with the dollar. The dollar saw a huge decline, and that's because yields actually fell as well, and that boosted overall commodities, particularly gold and silver, but not so much crude. But there's a lot of other dynamics working against crude. We also saw volatility subside substantially. Now with an 18 handle flat, we probably go to 17 next week. And all in all, a very bullish day across the board. The S&P 500, if we look at the daily chart, this is the year-to-date chart, looks very, very strong, but the week is done. So we're actually going to go to the US 500 and hop on the weekly chart, and we can see we officially made another weekly closing high in the S&P 500. Very, very bullish. And this is like the third or fourth weekly closing high in a row since we saw this volatile price action right here. We keep making higher highs, higher lows, new all-time highs or weekly closing highs in the S&P 500, and that's exactly what you want to see in a bull market. And I think things are going to keep doing this because the path of least resistance tends to be higher, especially when the macro is as good as it is. Earnings coming in strong, earnings expected to come in strong, margins growing, rate cuts on the horizon, inflation under control. All of that leads to pretty good market returns, and I just don't see that changing anytime in the future. So unless we actually see a substantial pullback below some of these key levels at 5,400 and I would say 5,100, until we start getting into the 51 to 5,400 range, that's when I would really start to get worried. Until then, all dips to the 5,400 area and above to be bought for us to go higher, especially if we do get volatility in the next week. Guys, you want to buy those dips until we see like closes and real price discovery below the 5,400 area to as low as the 5,100 area. That's when we can start to get worried, and I just don't see that happening right now. If we go to the daily chart, we're going to go to the S&P 500 now, go to the daily chart, and we can see, yes, there is a little bit of volatility and price discovery here at the highs, but that tends to happen. The market isn't just always going to rip up to the upside, especially at all-time highs. We are going to have up days, we are going to have down days, but the general trend is going to be higher, and you want to buy dips, sell rips, because we are in positive gamma. The gamma flip now 57.75. Just a week ago, it was at the 5,700 area, so it really did move up this week. So too did the core resistance, and they put support in the S&P 500, and you want to buy any dips we do get in this market, because I do think we are going to go higher. And I think the macro is going to keep surprising to the upside, especially since we are getting some of these strikes resolved and a lot of the weather developments we're seeing is subsiding, especially in the US with the hurricanes. Yes, a lot of people are still affected, but the worst is now behind us. And this means going into this Christmas period, we are going to have more positive economic data going into a seasonally strong period. That's exactly what you want. Looking at the NDX or the Nasdaq 100, this, I said it was starting to look like a double top lower high, but very constructive price action. We held the gamma flip at the 20,000, 20,100 level, and this is constructive for us to move higher. And what I really want to see this week is the Nasdaq 100 retake those all-time highs on the back of Nvidia, Google, and Meta rallying, as well as Apple with some of the news we got today. If we can see that next week, take out these all-time highs, that's going to be very constructive for the fourth quarter and rally into December, into January 2025. And so what we really want to look for right now is strength. We want to find strength in these markets because strength begets strength, and we're moving into a seasonally strong period. Now, guys, the election is the 4th of November, or for those of you in America, the 4th of November, like that. The election can cause a bit of volatility, but I think once that's behind us, a major event that can cause uncertainty will be behind us. Regardless of a Trump or Kamala win, I think the markets will move higher on the back that it has certainty as to who will be the president for the next 4 years. Looking at the RTY, even though the Russell 2000 did decline today, very constructive price action at these 52-week highs. We look at the year-to-date chart on a percentage return basis, double digits officially, 12.2%. That's very strong with 1 quarter into the year. I mean, I wouldn't even be surprised to see this at 20% at the end of the year if we do continue the strength we've seen in the Russell 2000. However, for that to happen, we will need to stay above the gamma flip and we will need to hold this higher low. As long as we do that, we can pull back to as low as the 2240 and continue the move higher. I do want to see this week a close at the current core resistance at 2325 or above this wick high. That's what I want to see. We go do that and it's off to the races for the Russell 2000. Very constructive price action across all of the indices. The S&P 500, Nasdaq 100, Russell 2000 above the gamma flips. The RSP, the equal weight, looking very, very strong as well. Look at the strong buying action we saw. We look at the weekly chart for the RSP. That's another weekly closing high. And we also had another weekly closing high in the last 52 weeks for the Russell 2000. This is the weekly chart right here. Very constructive. That's exactly what you want to see. And guys, this market looks strong. We are poised to go higher, not without some volatility, but buy those dips when you get them and hold equities because equities are going to move higher. And let's dive into seasonality, guys. I just want to talk about what is to come over the next couple of months, especially when we've had a January to September, which is greater than 10%. In 2024, January to September returned about 20%. And generally speaking, from the month of October into December, we see 2.83% average returns. But from late October into December, we can see average returns of 6.08%, 13 wins, only 1 loss in this data set, telling us, guys, that despite the massive year we've had, momentum brings momentum, strength brings strength, and we want to buy any dips we do get because we are about to see what is a pretty strong rally, especially from October 27th. We are on October 18th, 19th this week. So about a week before we enter this period right here. Nonetheless, we are in this October and December period, guys, and any dips you do want to buy because we do see quite a lot of strength from now until the end of the year. And this strength is backed up by fundamentals. And looking not just at 2024, at the long run earnings, guys, we do see, yes, earnings are decelerating for the Magnificent Seven, Microsoft, Nvidia, Amazon, etc. But we are seeing the S&P 500 median earnings actually increase into 2024, 25, and 26. So we are seeing a broadening out, and that is being backed up by the fundamental picture. But you still want exposure to these massive, big tech diversified companies because they are such high quality companies. And 21% growth, 18% growth, that's double digit growth, nothing to scoff at. You take that growth when it comes. And also on the back of all of this, S&P 500 profit margins are expected to expand in coming quarters. This is where we are right now, and we should see margin expansion from the 12.5 into as high as the 14% range, which is really going to help profitability as well as back up the high multiple the S&P 500 trades at right now. And all in all, guys, whether earnings is growing or decreasing, you don't actually ever want to sell your equities. Generally what happens is we just get a little bit of extra alpha when earnings are up year over year. Even when earnings are down year over year, returns are still positive 77% of the time. And we see average returns in the S&P 500 of 9.8% versus 10.2% when earnings are up year over year. But let's actually look at Russell 2000 earnings, and things are looking very, very good. Right now, blended earnings growth for the Russell is reporting at 38.7%. If the energy sector is excluded, we're looking at 64.7% in earnings growth. Very constructive. Take this with a grain of salt because we've only had 49 out of 2,000 companies report so far in the Russell 2000. And if you guys are looking for outperformance, the Russell is definitely the place you want to look at because the environment we're in right now it's actually quite fantastic when you look at it in aggregate. Bonds just had their second best quarter in 29 years. Generally speaking, bonds don't have phenomenal quarters if inflation is out of control. So inflation is under control. We're seeing central banks around the world pivot to an easing stance. The yield curve just uninverted, and small cap earnings are going blockbuster. Yet we've still had some very lackluster performance relative to history here in the Russell 2000. This is average returns from market lows, and in 2023 we've only returned 33%, where the average return in this time period would be 60%. And I do think it's time for a big catch up in small caps. And let's talk about the macro. Looking at the Fed's GDP now, we saw a huge uptick after the housing starts and building permits data. GDP now sitting at 3.3%, up from the 3.1%. Very robust. That's exactly what you want to see. And this is roughly in line with Goldman Sachs' GDP estimate for the third quarter. They see 3.2% for the third quarter. The consensus only sees 2%, which is very, very interesting. So I think either the consensus is going to have to move their targets up, or Goldman's going to have to move their target down. Either way, GDP is tracking at 3.2%. We're going to see who's correct. However, Goldman still sees significantly higher GDP growth in the fourth quarter, where the consensus only see less than 1.3% growth. So very, very weird dynamics here. I think the truth is somewhere in the middle, except for maybe the third quarter. I think the Fed's GDP now is more often correct than not. And I think a 3% GDP print for this quarter is more likely than not. But let's actually talk about the data we got today. And then looking at the data we got today, housing starts coming in at 1.35 million, in line with consensus expectations. Building permits missed ever so slightly, and this is very, very constructive. We don't want to see these data prints missing by a large margin, especially with rate cuts on the horizon. But the 10-year yield has actually increased since the Fed made that 50 basis point rate cut. So to actually see this data as it is largely constructive. However, higher rates will probably see this data set deteriorate in coming months. So we do want to keep an eye on building permits, housing starts, and mortgage applications. And that's something we're going to track next week. All in all, I still think this economy looks rather robust. Building permits and housing starts hanging in there. And this is a high quality, high frequency data set that we get every single month. Something else that's signaling to us that we shouldn't really be afraid is high yield credit spreads. They're the tightest they've been since 2007 at 2.9%. And until credit spreads actually blow out, I think we continue to hold equities because the credit market is not concerned with anything adverse happening in the markets. Looking at overall earnings for this week, guys, we got a big week of earnings, a huge Monday to Friday, no rest for the weary. Now on Monday, the big name that's going to be reporting is after the bell, SAP. That's a German tech company. Logitech is reporting as well, and that's really it. On Tuesday, we get Verizon, GM, 3M, Raytheon, RTX, GE Aerospace, Lockheed Martin, a lot of the defense names, as well as Enphase Energy, Seagate, Texas Instruments. Very big day for tech and comm services as well as defense. Then on Wednesday, we have Vertiv, Boeing, AT&T, Coca-Cola, Nextra Energy, GE Vernova, CME Group, Boston Scientific, General Dynamics, as well as Tesla, Lam Research, IBM, ServiceNow. So a very, very big day on Wednesday. Thursday, we get American Airlines, UPS, Nasdaq, Southwest Airlines. We also get Dexcom, Deckers Brands, Western Digital after the close, Texas Roadhouse, Union Pacific. Very big day on Thursday. And then Friday, we get New York Community Bank Corp, Colgate Palm Olive. And that's really it on Friday. So a huge week of earnings, guys, particularly Tuesday, Wednesday, Thursday. We have some of these big semiconductors and tech names reporting, then that's really going to move the market, particularly Lam Research, as well as Texas Instruments for semiconductors, defense on Tuesday, airlines on Thursday. A very big week of earnings, so be prepared for some volatility. And then data for this week ahead, guys. On Monday, we have the leading economic indicators. That's the major data print on Monday. On Tuesday, we don't really have anything. On Wednesday, we got existing home sales as well as the beige book. Then on Thursday, we got initial jobless claims, PMIs, services and manufacturing, as well as new home sales. So more housing data. And then Friday, we get durable goods. That's the big data print coming out of this week. So the big event is obviously going to be earnings, but we can definitely see some economic volatility, particularly with some of the housing data, and that's really going to affect the rate market overall. But if you've made it up until here, thank you so much for watching. If you like this video, please subscribe, hit that notification bell, as well as the like button, and leave a comment for the algorithm. Cheers.